The last topic what we have here is not-for-profit organizations and public sector. So the one classification of organizations is organizations are classified based on the objective for which um, they are established. What is the basic purpose behind the organization being established? So broad classification we can call it as those that want to maximize profit, and those organizations which do not even want to make profit. So the organizations which are established to maximize their profit or make profit, they work towards maximizing their profit or take every possible measure to ensure that sales is generated, sales is maximized, then a profit part of it is also taken into consideration. Profit has to be maximized either by selling more number of units or controlling the cost. So various ways in which the profit has to be maximized. Then we see there are certain organizations which are established, but their objective is not to make profit. Then why are they established? There is some objective behind that which is not connected to the financial aspect of it. Um, Maybe there is some service which they want to render to the society at large or a specific group. So some service motive is behind they establishing the organization. So such organization we call them as not-for-profit organizations. NFPO, not-for-profit organizations. Now, the point here, what we are studying, the previous class also we were studying about it. So it was about how do we measure the performance. So that under that aspect, we have looked into various ways in which the performance is measured by way of ratio analysis. Then other models are there. So we have learned about that. So a major part of it revolves around whether it is financial, non-financial. See, ultimately, it comes down to the point about how much profit can they make out of this. Um, in case of not-for-profit organization, we see that um, there is no concept of profit. So how would we um, measure the performance, evaluate the performance? What parameter would be taken into consideration? So here, if it is not-for-profit, if that is not the objective, then the performance is also measured in such situations where the performance measurement is taken up by three E's. So they are measured, they are present here in this particular image. The first E talks about economy. The second E talks about efficiency. The third E talks about effectiveness. Economy. See, just because there's no profit, it doesn't mean that any amount, anywhere, any uh, way they want to spend, is that acceptable? Of course, because profit is sales minus cost, and in case of profit organization, cost control would be playing a major role. So there, the importance is to cut down the cost. Cost control is one important aspect there. But here, since there is no concept of profit, are they allowed to spend as much cost as they want to? So that is what has to be looked into. So here, if that is the case, the a major part of the amount will be just spent like that without achieving anything. So here, what we have to understand here in case of not for profit organizations are what is the objective behind establishing such an organization. So we need to look into what is the objective. Sometimes these organizations may have multiple objectives. It is not just one objective based on which the organization is set up. There may be multiple objectives. So in that case also, these objectives have to be ranked. The most important or the high priority one is ranked one. Then in that order, we see other objectives also rank. But whatever it is, there is an objective or there are multiple objectives by what they want to achieve. Maybe um, see, the society at large, they may take up something like um, environmental related activities or planting of trees, or a particular part of the society, a particular section of particular community to which they want to cater to, a social class they want to cater to their. So no matter what it is, there is some objective which is there behind these organizations being established. So to achieve the objective, they have to spend cost. Objectives can be achieved only when some amount is incurred. That is the case. When they are incurring the amount, when they are spending the cost, is that resulting in they achieving the objective? So to achieve the objective, they have to spend cost, but too much of cost spent will not enable them to achieve all the objectives or the whole objective. Therefore, measures should be taken whether they are cutting down on the cost or have a proper cost control. Instead of wasting the cost, instead of wasting a lot of amounts, they, whether they are taking any cost control measures or not, will be taken into consideration if the performance is measured. Now, how to measure the performance? These three parameters are there. Apart from that, there is something else also we'll discuss. So, first part of it, is there any cost control effort put in to cut down the cost? That's the first part. Second one, the efficiency. Efficiency is as much as the cost is incurred, are they getting the benefit? Cost benefit analysis. Their efficiency would be, now benefit is not in terms of profit, but benefit is in terms of achieving the objective. So cost benefit analysis, whether they are efficient enough, if whether there is efficiency in realizing the objectives being achieved. So whatever is the cost which is incurred, first cost control measures, then when the cost is incurred, they should also get benefit. Now, together, these two things, they have to understand that the input is the input, whatever is incurred or spent, whether the output is according to that. When we consider that, that becomes the effectiveness. So here, the cost control part of it and the efficiency about getting a benefit together, they measure what is their output generated out of the input which is introduced. So the output here is not anything in financial aspect, but it is in terms of achievement of the objectives or fulfilling their objectives. So if these efforts are put in, if these things are taken into consideration, this is how it is measured, then it becomes possible to measure the performance of a not-for-profit organization also. Okay. Then see, in isolation, if it is not possible to know something, then there is a concept called as league tables are prepared. What is that? The organizations which are on par or similar organizations. So on a comparative note, their performance is measured. So because their performance is compared with other similar organizations, there would be effort put in to perform their best, control their cost, and then get the benefit for the cost which is incurred, and ensure that their objectives or the output is achieved by uh, achieving their objectives. So that is what is what will happen when league tables are prepared, when they are evaluated on a comparative note. So that comparison talks about they doing it better. Of course, there are certain disadvantages when the comparison comes into picture. Then they maybe shift from rendering services to um, being evaluated as the best. So the core objective is to serve the society or serve a particular group of the society. So that is their intention, that is their objective behind establishing that. But once the comparison comes, maybe their focus will shift from that to being rated as the best. So that is another danger. But that's one way of measuring the performance. So we see here that is what is explained. Economy, what is the money spent versus what are the inputs which are purchased. These inputs which are purchased, is there any output which is realized out of that? The output which is produced enables them to achieve the objective. So all of them together, there is a concept called as VFM, which is value for money. Then finally, we see what is cost control and cost reduction. Cost control involves the setting of targets for cost centers. Cost center managers and then monitoring performance against those targets. Cost reduction is putting in effort to identify where there is waste and eliminating that waste, reducing that. Okay. Cost reduction, on the other hand, it is reduction in unit cost of goods or services without impairing suitability for the use intended, without reducing value to the customer. So here, anything which can be reduced, which can be cut down, is cut down, but yet at the same time, the intention is to not compromise on the value. For example, if they want to cut down on the cost reduction measures are taken. Um, it would not be appropriate if they compromise on the quality of material which is purchased. Cost has to be cut down. But in this effort of cutting down on the cost, at no given point of time, there should be a compromise on the value which is contributed to the customers, which is offered to the customers. So that's called as value analysis or value engineering. There should be no decrease in the value which is offered to the customer, yet there should be an effort to cut down on the cost. So carefully analysis has to be taken up to understand what are the unnecessary irrelevant costs. So work out on those things and eliminate them, but should not go in for purchasing cheaper raw material or employing semi-skilled workers or something like that. See, those kind of things will ultimately affect the quality of the product or service. That will cause some dissatisfaction among the customers. Okay, so that way it would not be helpful. So the value part of it should be intact. Value analysis is a systematic examination of factors affecting the cost of product or service in order to devise means of achieving the specified purpose most economically at the required standard of quality and reliability. Work study is a systematic examination of the methods of carrying out activities in order to improve the effective use of resources and to set up standards of performance for the activities carried out. Here, there is a target setup. Let's say that if the cost, one second. Yeah, sorry. Work study is a systematic examination of the methods of carrying out so that um, in order to improve the effective use of resources and to set up standards for performance of the activities carried out. So uh, this is all what we have in the syllabus. Then after that, one chapter is about how spreadsheets are used. Uses of spreadsheets. Spreadsheets, when they are used, they help in comparison. Um, they help in planning. So uses of spreadsheet in terms of preparing budgets. So budgets are financial plans which are prepared so that it becomes easy to make a comparison and then take up the analysis accordingly. Budgets or variances or various reports which are prepared. What if analysis is verifying or testing out whether a change in the input can result in a change in the um, output, and to what extent is the change in the output, testing out with multiple changes, how sensitive is the output to the changes in the input is tested under what if analysis. We also interchangeably use it with the concept called as sensitivity analysis. I think you will get to learn about these things in some other paper. So when such experiments are taken up while making a change in the input, what is the impact it has on the output? So what if this happens? What is the result on the, or what is the impact on the output? What if that happens? What will be the impact on the output? So such an analysis, when it is taken up, we call that to be as what if analysis. So when these things are prepared, spreadsheets are very useful. So because it is presented in a vertical format, then having another see, in one column, if we have for budgets, if the budgeted figures are there, another column the actual figures are there, it becomes easy to make a comparison and take up the analysis. So that's the basic uses of spreadsheet. Okay, so that's the last topic done. um, we have not worked out any numerical question on performance management, and then halfway through we worked out very few questions under variance analysis. All the other topics, at least one or two questions at least we've done. So first we will focus on these two topics, and then we'll think about what we can do if at all, if time is available. I have my own doubts that the time would be available. What was the last question we've done? 300. We didn't do 358, no? So let's take it up, question number 358, and work it out. Question number 358. Let's answer this one. This is variable overhead variances. A company makes a single product. The following details are from. Did we do this? We didn't. A company makes a single product. The following details are from the cost card of the product. We have direct labor, the variable overhead. Rates are given, calculated based on per hour. The actual results for the last period are 500 units produced. Labor cost is labor time is 4,800 hours, and variable overheads cost is $7,700. What are the variable overhead expenditure and efficiency variances? Variable overhead expenditure variance and efficiency variance. These two things are given. Um, Standard variable overhead rate per hour minus actual variable overhead rate per hour. Second, I'll bring this to the next line. Not sitting here. The difference between the standard variable overhead rate and the actual variable overhead rate applicable for the actual number of hours, actual hours. So three variables are there. What are actual hours? We see actual hours are 4,800. Then we need to look into what is the standard rate. Standard variable overhead rate per hour is 1.5, and the actual overhead rate, uh, the cost is given, so we can find out. Three variables are there. So find out what are actual hours, 4,800 standard variable overhead rate is equal to, it's directly given 1.5 per hour. But then actual actual variable overhead rate is equal to, see, the total cost is given as 7,700 and the number of hours are given as 4,800. So just divide 7,700 divided by 4,800. So that gives us what is the actual variable overhead rate. Substitute that and then find out what the answer is. We see that the actual overhead rate is more than the standard overhead rate. So we have to mention it as favorable or adverse. What do you think? It is adverse because the in terms of cost, we see that actual cost should always be less than the standard cost. But here the actual cost, the actual rate is more than the standard rate. Therefore, it becomes an adverse variance. Then efficiency variance, we have learned under same um, usage variance or labor efficiency variance. Similarly, we would present it here in case of variable See, efficiency is measured in terms of what is the usage. In case of material usage variance, we compare how much quantity of material was decided, how much was used. So the difference between that applicable at the standard rate. In case of labor efficiency variance also, what are the standard hours, what are the actual hours, how many actual hours were used, applied at the standard rate. So similarly, in case of variable overhead efficiency variance also, there is a comparison between what are the number of standard hours and what are the number of actual hours. So um, the difference between those hours applied at the variable overhead rate. Okay, so here we will write it as variable overhead rate per hour. The usage part of it. So we see the standard hours minus the actual hours. So present whatever are the standard hours, the standard rate, actual rate, and variable overhead rate per hour, and variable overhead rate per hour. See, the output is 500 units. So for 500 units, the actual hours are given to us as 4,800. So we know what are the actual hours because they are already mentioned. Now these actual hours are for an output of 500 units, so 4,800. But in case of standard hours, see, the standard hours are given as per unit. It says that 10 hours are required for every 1 unit and the rate is at 1.50 per hour. So standard hours when we calculate, we have to take it for the output which is 500. For 1 unit it is 10 hours, but then for total output of 500 units, how many hours? So here we would calculate it as 500 into 10 hours. So the total standard hours allowed are 5,000. 500 into 10 is 5,000 hours. So just substitute variable overhead efficiency variance is equal to rate. Um, Now is this so now 300, is it adverse or favorable? So we see that the standard hours are given to the extent of 5,000, but they consumed less number of hours. So less number of hours, 200 less number of hours. So on that note, this will become a favorable variance. So this is 300 favorable. Let's work out another question. 360. Question number. A company operates a standard marginal costing system. Last month, actual fixed overhead expenditure was 2% below budget and fixed overhead expenditure variance was 1,250. What was the actual fixed overhead expenditure for last month? They are following marginal costing system. I hope you remember what is the criteria about the marginal costing system and how do we differentiate it with the absorption costing system. What is the main difference? What is the main point of difference? Any one of you? I remember we doing it. We have done that. The difference, the main, there is only one point of difference. The impact is seen, but the point of difference is um, see the way the fixed overheads are charged to the ending inventory. So that is where we see the difference. In case of marginal costing system, they do not consider the fixed overhead cost to be charged to the ending inventory, but fixed overhead costs are also charged to the ending inventory under absorption costing. That's the point of difference what we have to remember. Now here we see that um, there is a difference between these two methods in terms of the fixed overhead expenditure. There are only two details what are given. We see that last month's actual fixed overhead expenditure was 2% below the budget and the fixed overhead expenditure variance was 1,250. So if the actual fixed overhead is 2% below the budgeted, so we do not know what is the actual, what is the budgeted also, we do not know. So the budgeted fixed overhead minus the actual fixed overhead is the variance what has to be calculated. And then once that is calculated, they have seen that it is a variance of 1,250. So that all what we have is only these details. So we see that the difference between the actual fixed overheads and budgeted fixed overheads talks about what is the fixed overhead expenditure variance. So let's first write what is the variance. Fixed overhead and this happens to be 1,250. How do we present that? Um, we do not know both the variables. The only point of difference which is given is whatever is the budgeted fixed overhead, 2% less is the actual fixed overhead. So all what we can remember, what we can understand is the actual overheads are 2% less than the budgeted overheads. So we can put it as let budgeted overheads be. Um, Otherwise, also we can directly write it. We will put it as budgeted fixed overheads minus. Now, what is actual fixed overheads? They are 2% less than the budgeted fixed overhead. So, in place of actual fixed overheads, we can put it as budgeted fixed overheads into 2% less, no, 98% is equal to 1250. So just calculate. So 2% of budgeted fixed overheads is equal to 1250. So if it is 1250, take it divided. So how much would it be? 1250 divided by 2%. 62,500 will be budgeted. We want actual fixed overhead. So here it would be this into 98. Did you solve it? Did you solve this one? So here we would have budgeted fixed minus 0.98 budgeted fixed overheads. So in this case, it will be 2% of budgeted fixed overheads is equal to 1250. So budgeted fixed overheads is equal to 1250 divided by 2%. So that is equal to, then we see that actual fixed overheads are 98% of budgeted fixed overheads. So is equal to 62,500 into 98%. So that is equal to 61,250. $366. QR has budgeted to produce 4,000 units in January. Actual production was 3,700 units with fixed production overheads of 10,300. The standard fixed overhead cost per unit was 1.5 hours at 2.40 per hour, 5,800 actual production hours per work. What is the fixed overhead volume variance? Volume is about the What's the standard fixed overhead rate, which is 1.5? No. Rate is the standard fixed overhead cost per unit was 1.5 hours at 2.40 per hour. 2.40. Now we need to know what are the standard hours is equal to the budgeted QR has budgeted to produce 4,000 units, but the actual production was only for 3,700 units. Now, the actual output, if it is 3,700 and the budgeted details are given at 4,000, we actually have to take everything adjusted according to the actual. Actual output is 3,700, for which the cost is 10,300, and the actual number of hours are 5,800. So let's just write what are the actual hours. Actual hours is equal to the total number of hours are 5,800. Now coming to the standard hours. Standard hours, it's given as 1.5 hour per unit. So we should not be calculating it for 4,000 units, but we should calculate it for 3,700 units, because both of them should be on par for comparison. So 3,700 into 1.5 talks about what are the standard hours. Now substitute that and then find out what's the variance. Is it adverse or variance favorable? The answer is we don't have the spell here.
Adverse, ma'am.
No, no. Actually, the answers are not matching here. We got the answer as 600, but they are not matching. So that's what I'm looking into. Fixed overhead expenditure variance under marginal costing. We see actual expenditure minus budgeted expenditure. The difference between that. Then volume variance. See, volume variance. I'm really sorry about this. The Definition of volume variance is the difference between the budgeted overhead cost and the actual overhead cost without adjusting it to, I'm putting it to some internet site here. So here it says, volume variance is the difference between the total budgeted overhead cost and the amount, actual amount of overhead cost. It is not adjusted according to that. So on that note, that's a mistake I made. So let's rectify that, this part of it. So here the budgeted overheads are whatever decided, not adjusted according to the actual output. So the budgeted overheads are at 4,000. So we would make it as 4,000 units into 480. The actual hours are 5,800. The standard hours are 6,000. I have my doubt. Let's take up the sales variance. I'll put it here. One question on sales variances. Question number 372. A company is reviewing actual performance to budget to see where there are differences. The following standard information is relevant. We see the details and the per unit details about the selling price and the other costs. What was the favorable sales volume variance using marginal costing? See, when we are talking about the sales variances, if it is marginal costing, then they take into consideration the contribution per unit. If it is absorption costing, the criteria would be profit per unit. So first we need to find out what is the contribution margin per unit. So the sales volume variance will be calculated considering what is the volume of activity and apply it at the contribution margin per unit. Right, sales volume variance is equal to sales volume variance is equal to the difference in the volumes. Okay, the difference in the volume of sales activity. The budgeted sales units are 3,000, actual sales units are 3,500. So we see that there is a difference between these two. Now this has to be applied at the, because it is marginal costing, at the contribution per unit. So the difference in the, so let's find out what is contribution margin per unit. Sales minus all variable costs. Because it is per unit, selling price per unit minus the variable cost per unit. Selling price per unit is 50. Variable costs are, all direct costs are variable in nature. So we see direct material, then we see direct labor, then we see variable production overheads 10. Selling price is 50 minus, let's list out all of them in a bracket. Direct material, all direct costs are variable, so 4, then plus we have 16, direct labor, plus variable production overhead is 10, plus variable selling cost is 1. 20, 30, 31. So 50 minus 31, 90. 9,500. So is it a favorable or adverse? How do we understand it? See, they intended to sell only 3,000, but the actual sales which took place are more than the budgeted sales, which is 3,500. On that note, it is favorable. When the actuals are better than the budgeted, then we call that to be as favorable in case of sales, because this is output. The actual output is better than the standard output. So 9,500 favorable. Anyway, it is also asked in the question about calculating a favorable sales volume variance. Then question number 373. After this, we'll go to ratio analysis and work out a few questions from there. A company uses variance analysis to control costs and revenues. Information concerning sales is as follows. Budgeted selling price is 50. Budgeted sales units are 10,000. Budgeted profit per unit is 5. Actual sales revenue is given. Actual units sold are 9,800. The question says what was the sales volume profit variance. It is not contribution. That is not margin costing. If it is profit, it is absorption costing. Of course, it's not mentioned as absorption costing, but the very fact that they are looking at calculating the profit, profit is calculated under absorption costing. So we have to take whatever is the budgeted profit per unit. Budgeted profit per unit is given to us as 5. Then apply whatever are the details. Budgeted volume profit per unit in bracket. Now the difference between the activity level. So we see the budgeted sales units are given to us as 10,000 and the actual sales units, they are given as 9,800. So right, budgeted sales units minus actual sales units. Substitute this and then arrive at the answer. Budgeted volume profit per unit, which is given as 5, 10,000 minus 9,500.
Ma'am, 9,800.
Yeah, thank you. So 1,000. See, they intended to sell 10,000, but they ended up selling less number of units. So it is adverse. Okay, so then you work out the other questions also from the examination kit. The remaining time we'll work out few questions from the ratio analysis part of it. $391 question number. A division has a residual income of 240,000 and a net profit before imputed interest of 640,000. If it uses a rate of 10% for computing imputed interest on invested capital, what is its return on investment to the nearest whole number? First, let's define what is RY, what is RI. So then we can take it up. The formula for ROI is equal to, we see the profit margin divided by investment amount. So the total investment amount, that's not given. So investment amount. Then we have the equation of RI. RI is residual income. Is equal to, the formula for RI is, we see the operating profit, operating profit minus see the investment amount or the asset amount, whatever we call it as investment amount into the rate, the cost of capital. Into the cost of capital, which is mentioned to us as the cost of capital is given to us as 10%. Operating profit, what details do we have? So we have RA, residual income. The calculated value stands at 240,000. The other thing is the profit before imputed interest of 640,000. So the profit margin is given to us before paying any cost of capital, that is interest or dividend or any other thing. Before paying anything, the profit stands at 640,000. So if this is 640,000 and RI, the calculated value is given as 240,000, the rate is given, the cost of capital or rate of 10% for computing imputed interest on invested capital, that is nothing but cost of capital. So cost of capital is given to us. We have this to be as 10%. So I think we can find out what is the investment amount. Operating profit is 640,000 minus into 10% is equal to RI is 240,000. Find out what is investment amount. How much is investment amount? So that is 4 million or 400,000. 4 million or 40 lakhs, sorry, 4 million or 40 lakhs. Once investment is known to us, we will be able to find out what is ROI, because ROI is equal to profit divided by investment. Calculate what is ROI is equal to profit amount is given as 640,000. 640,000 divided by 4 million. %16 when this is converted. Use the following information for the next 7 questions. We have a condensed balance sheet which is given. No, condensed income statement and certain items of the balance sheet. So these details are given. Inventories, receivables, cash, payables, overdraft. Then on the other side, we see revenue, cost of sales, gross profit, admin cost, distribution cost, operating profit, and then finance cost. Now, with these details, we need to find out there are certain things which are asked. What is the company's current ratio? So let's write current ratio is equal to, we have it as current assets divided by current liabilities. What are current assets? From this information, what we see is inventories, receivables, cash. These 3 items are current assets. Payables and overdraft, these 2 items are current liabilities. So let's quickly write what are current assets. 150 plus 300 plus 25. Then we see current liabilities is equal to, only 2 items are there, 230 current, the payables plus the bank OD is also current liability. So this is equal to, find out current ratio is equal to, this is 1.4843, that many number of times. Or we can write it as 1.48 is to 1. Then question number 400 talks about what is the quick ratio. Quick ratio is equal to quick assets divided by current liabilities. You need to have very good hold on what are the formulae. So in the examination, you should not make a mistake of taking anything. Please have a thorough knowledge about every ratio, every formula. So quick assets, all current assets are quick assets except inventory and uh, prepaid expenses. So we have the current assets minus, in this problem we only have inventory. So take those things and then mention that we already calculated just now what are current assets. Current assets are 475. So 475 minus only the inventory which is 150. $325. We know what are the current liabilities. Current liabilities are 320.
Ma'am,
What happened?
whether it is not 175. In current assets, we have included inventories there, no, ma'am.
That's why we are eliminating inventory only. Current
So the total is 475 there, including inventory.
Okay, so from the total, we are only eliminating inventory. Otherwise, also receivables plus cash, 300 plus 25, 325.
Okay, ma'am.
What happened? What is the confusion? Current liabilities are, we already calculated, which is 320. 320. Four zero one. 401 says calculate what is receivables payment period. So in a year of 365 days, what is the receivables turnover ratio? So let's present that. Divided by receivables turnover ratio. Receivables turnover ratio. Let's first simplify that, calculate that, and then substitute there. Receivables instead of having everything, because denominator is also again a fraction. So that would result in some confusion. So let's finish off the calculation here separately and then take it there. Receivables turnover ratio is equal to, the numerator is turnover, denominator is receivables. But turnover here in case of this is credit sales. But the question doesn't mention whether the sales are credit sales or cash sales. So whatever sales are there, if there is no information, assumption is that all sales are credit sales divided by receivables. The revenue is 2,700. There is no clear-cut distinction whether it is cash or credit. So we assume it to be credit, and then 2,700 divided by receivables are 300. So quickly do that. 2,700 divided by 300. So that comes out to be as 9 times. Next, receivables payment period. Is equal to 365 days divided by 9 times. So the answer would be is equal to 365 divided by 9. So 41 days. Round it off and then it becomes 41. 41 days. Then we see 402. 402 is asking about the payables payment period. Similar fashion, the way we have done. The difference here would be in payables turnover ratio. It would be purchases, credit purchases divided by payables. Let's present it quickly. Payables payment period is equal to, see in question sometimes the number of days in a year can also be mentioned as 360 days. Why? Because uniformity sake, they assume that 12 months in a year, each of them having 30 days. So if that is the case, 12 into 30 is 360. So that is an assumption, and it can be taken. You should be taking it if it is mentioned there. But if there is no mention that how many days in a year are there, we go with 365 days. So then the denominator is payables turnover ratio. First, let's calculate payables turnover ratio is equal to credit purchases divided by average payables. But that logic anyway you're not learning. So let's take this one. When here we don't see anything related to purchases. What we have here is revenue is there, cost of sales is there, gross profit is there. How much is the purchase part of it is not mentioned. So in such situations, if we can put in an effort to find out um, what is the amount of purchases, how do we find out? There is an equation called as cost of goods sold is equal to opening stock plus purchases minus closing stock. Do we have those details? Those details are also not mentioned to us. What we have is only about um, the cost of sales. So in such situations, because of absence of information, we proceed further and then take the total cost of sales to be as the total cost of purchases. In situations where we have the opening stock, the closing stock, in such cases we can use that equation, cost of goods sold is equal to opening stock plus purchases minus closing stock, and then find out. Because it is not there, we can take the cost of sales, the total cost to be as the cost of purchases. So here we will have it as 1300 divided by payables are 230. 365 divided by 5.65. So 60 5 days. Four zero three is inventory holding period. Question number 403. The same is the logic. The term is mentioned as inventory holding period because how long do they hold the or how long is the inventory held by the business before it gets converted into cash. So inventory holding period. So in a year of 365 days, 365 days divided by inventory turnover ratio. So inventory turnover ratio is equal to, the formula is cost of sales, cost of goods sold, cost of sales divided by inventory. Cost of sales we know 1300, inventory is 150. 1300 by 150. Then inventory holding period is equal to, you just directly substitute that now, 365 days divided by the turnover ratio. This is 42 days. Next we have 404 is what is written on sales. Return on sales is equal to return, which is also called as profit. Profit divided by sales into 100. So profit amount and then sales amount. Two details we need to find out. Profit, operating profit is 550. Sales is 2700. 550 by 2700. So when you multiply into 100, then you would get what is the percentage. So this is 20%. Return on sales is 20%. Then the next question is about what is the interest cover ratio. 405 interest cover ratio is equal to whether the EBIT, here EBIT operating profit is given, whether EBIT is sufficient enough to cover the interest expenses, interest or the finance cost, because that's the term which is mentioned there, finance cost, that is interest cost plus any other cost, any other type of cost of capital which is paid. So we have to take the profit which is equal to 550 divided by interest is 75, finance cost is 75. 75. So here this is equal to, so this is 7.33 times. Okay. I understand it is an exempted paper. You don't have to work out so much, but take my words, you have to I mean tell yourself that you have to learn this, you have to practice these questions. I have mentioned earlier that there is no exemption. There is no exemption in terms of not learning the subject. You have to learn the subject, and you have to learn the subject for a lifetime. That is what the performance measurement tools and the entire syllabus across MA paper will be repeated till you pass the advanced level papers. And then these are the things which you will be also applying in your organization. So don't ever think that this is an exempted paper. We don't have to work out. See, it's your choice again. But then if you don't work out, then again you will be at a loss. So for that reason, you should be taking up and then you should be calculating, working out these questions. There are many questions. See, out of 400 odd questions, we did not even solve 100 questions. Because given the time constraint, within that limited time, what best we could do, we have done. Okay, the time part of it is the main constraint what we have. So whatever I could do in terms of working out the numerical questions, I have done. There's much more which has to be done, but of course we don't have the time. But I have taken you through all the topics whatever are covered in the syllabus. So the recordings also will be available to you. I am finding it difficult to upload that, so maybe I should take somebody's help and then finish it off in today's class. So from the LMS only you will be able to have an access to the um, video recordings. So I will send a message to your rep also that the work is done, and then you can download it and see from. I do not know how it works out. So once they are uploaded, you can view that. On some of the days we got disconnected. I got disconnected, so the video will be in two parts. I will mention part one, part two. So accordingly, you see that. So okay. So anything, any doubt? What you have? We have just 3-4 minutes left. Any doubts or anything which you want to clarify now? What happened? Many left. Only 49 are there in the class. Anything else? Am I audible? Nobody's responding.
Yes, ma'am, you're audible.
Okay, nobody is responding, so I got a doubt. Okay, keep working hard, study well, remember everything, whatever is done, and then much more which you have to personally sit with the material and then study. I have shared my number with you. You can also approach me for if there is any doubt, get your doubts clarified. But at the end of the day, it is your effort which matters. We are only facilitators. We can help you to do the work, but you have to have that self discipline and then study well. So, please work hard, study well, and excel in your studies.